make sure, yeah, 79.60, moves all the way down to right around 74. Um, and where it bounced was confluent with the DVA low. I'll pay attention to that, but again, I'm not getting out just because there's a line here. I'm getting out because if I see problems with liquidity and sellers struggling to get through liquidity, which I did, right? So these were the moves. This was the move straight down from the 79.60 where I shorted. That's up here, and you can just see it blow right through all of this liquidity. There is no reason to even consider getting out of this trade until you can see some buyers fighting back, right? I mean, through this liquidity, this liquidity, this liquidity, heavy liquidity, just right through it. I mean, you see a little blips of buying, but it means nothing because they're not. It's not responding. And, you get a couple buyers here, but again, I want to see. I'm not worried. I just caught a huge move in this trade. If I see it start to trade above this, right? Like if it would have come here and moved back above, then I would have, I would have got out. I would have made $3 on the trade, right? But I gave it a little room, and then, I saw it come down to the low right around 73. Buyers came back, and now, the next time the sellers come back in, and now here comes all this bid liquidity back, right? So now I'm paying attention. Again, I'm still in it because I got out of a portion, but the second half I'm still in because I want to see it get above. If it can get above these areas, and again, you want to pay attention to these prior liquidity areas and what it does when it comes back, right? So here's a perfect example. Buyers engaged as it came back to this area. Liquidity was put back in. They hammered it, rejected, right? So I think I'm okay, and now I'm expecting to move down to this liquidity. That did not happen, but it's just showing you that there's something amiss, and you got to be ready to cover this trade, right? So it comes down. Sellers try to engage, nothing. Try to engage again, nothing. Buyers come in again. Sellers try to engage again. Well, not one of these three times could it get down to even get down to this liquidity, which I would have probably been out if it struggled at all. But now I got to make a decision, right? So the minute I see the buyers come back in, and then it gets above this liquidity that's resting, which was also, again, where this liquidity was, I'm out right here, right? So I made, close to, again, I sold some over here, I covered some over here, and then I covered the rest here. It was an average of about $6, $5.75, $6. But the point of this is to, you don't want to just get out because you have a profit. You want to wait and see, these buyers winning, and they, lo and behold, the sellers can't push it, and then here come the buyers. You're out. Huge trade, risking 60 cents, and you made, I made almost $6, which is that's how you make money trading. So my next example is Microsoft. This was from 1/30/2020. Microsoft gap higher to an all-time high near 176 in pre-market trade, beating EPS estimates by 13% and revenue by 3%. Microsoft sold off on the open on over 7 times relative volume, retesting VWAP twice into the high relative volume conviction bar, holding below VWAP for close to 20 minutes before the second attempt. Ran into heavy refreshed liquidity, and an aggressive seller immediately came in. Market pushed through 172.50 and then tried to push through 172 where liquidity was taken out, but sellers couldn't sustain. Buying came in around 172.20 where a cover was warranted, risking 40 cents to make $1.10. So again, this is quote unquote great news. They crushed earnings. The average trader is pummeled on this trade, right? The market opens, they're like, oh, I want to buy this, and it just rips through, right? So it rips straight down on, this move all from here from 174 down to 172 is an extremely heavy volume. It was 7.6 times volume. So so this is the 2-minute chart, this is the 5-minute chart. So I actually I like to see 15. My rule of thumb is 10 to 15 minutes. You want to see holding below VWAP. But when you get instances of these types of tails where it just can't get through. Actually, I'm sorry. This was 15 minutes. The next example is where I cheated a little bit. I got in a little early, but sorry. So this was this tried to move above VWAP here and then here. So I shorted on the second attempt, which was almost 25 minutes below VWAP. Again, this is confluent with I put additional variable. Again, if you can add additional variables to the trade to make it stronger, it's even a better trade. So I'll trade VWAP whether this was a high volume bar down or not. As long as there's liquidity here, which I'll show you. But now you have the added factor of the liquidity, the high relative volume on this move down. So all of these traders that were buying in on the open, you have to think like you're that trader. If that market comes back, you want to get out of that trade because these guys get run over. So the minute it comes back, this is why it struggles, because then these guys that got run over, they went out. And then you add in the guys that trade VWAP on the other side of VWAP, you're shorting it. Now you have a double whammy. So that's kind of the methodology or the mindset behind playing into bars, high relative volume bars, because you got guys that are praying it comes back so they can get out because they got run over. So this is what it looked like on Bookmap. This was the first attempt here. That was here, but again, this wasn't. I actually didn't take this trade here. This was only 10 minutes, almost 15 minutes below VWAP, but it wasn't quite at the time, so I kind of waited. Again, I see the buying here. They take out liquidity, but it's immediately wrong, right? So kind of balances here. Can't get through this liquidity. Finally does. Then one more attempt, again, takes out liquidity, again, immediately offsides. So I have the annotations here, connotations. A second attempt to try to break through VWAP, met with heavy liquidity and heavy buying that was immediately rejected. Entry and first aggressive selling. So the second I saw this, again, I was waiting to see. I was expecting it to blow through. This was positive news for the stock, and why can't it get above this area? And if it would have blown through, then I just would have watched, but again, it didn't. This is a great trade. I sell here. Again, you have the confluence of this bar, this heavy volume with the VWAP, with the liquidity here. So I'm in here. I'm risking above here. So this is 173.20. I was risking about 173.60-ish. Again, which is above here. If this market comes up and blows through here, then I want no part of the trade. So sellers engage. Gets down through this liquidity level. Looks like buyers might, and I actually got out of a piece here just because the buyers kind of stepped up right here. I got juked a little bit, and this is going to happen sometimes, and that's why you get out of pieces of your trade. You don't have to get out your whole trade here. Again, you have a nice profit, give it a chance, right? So I got a little bit here, and then sellers came in again. Now this was a different story, right? So the aggressive sellers took out this liquidity level, but you can see the selling kind of dry up here. The liquidity level's gone, and there's no push through, right? So then the buyers re-engage here. I got out, when I saw this, I was out of the whole trade. So I was, again, risking 30 cents, 35 cents-ish to make. I got it at 172.20, so we're talking, a little over $1. So again, great risk reward. You're talking about four times your risk, and that's what makes trading. And you can use these levels to have a great risk reward. So for people that like to trade the balance areas, it did come back to the bottom of this balance area where it broke down from, which was this same thing where it broke down from when it retraced to here. There's nothing to do here, but then when you see the sellers come back in, now you see the liquidity come back in and the sellers re-engage. You could technically have gotten back in. I did not. But again, this just shows you ways that you can re-enter the trade. Just because you get out here, it doesn't mean you can't get back in if you see something that shows that the sellers are back in control, right? So if you see this liquidity, see this, you can get back in, 172.60, 172.50, and risk up to 172.75 again, or even up to here. If you're convinced. So I did not do that, but I'm just showing you how there's ways to, get back in for a portion to see what happens. And lo and behold, it comes down. This time it does break down through this liquidity level. I don't have the rest of the chart, but it went down maybe another 30, 40 cents and then hit liquidity and then actually rallied the rest of the day. But again, this was a great, the whole setup was the gap, gapped up, should not be below VWAP, failed at VWAP twice, caught the nice move. It actually traded down to here, and then it was up the rest of the day. But this was a great 4-to-1 risk-reward trade. Next example is Apple, 129.20. Apple gapped higher after crushing its earnings per share numbers and raised guidance 5%. Apple tried to rally on the open and put a large selling tail on 7.6 times relative volume on the 5-minute chart, closing below VWAP. Two subsequent tries to rally above VWAP failed in additional selling tails and failure at large resting liquidity on the attempt at 8:42 a.m. Central. Aggressive sellers then engaged and pushed Apple lower to the first major liquidity at 323, were rejected at its first attempt. Moved back for one more attempt to push through VWAP. This time with weakened buyers that couldn't even push to the resting liquidity at 325, and sellers engaged again. Apple moved through 323 on next attempt and couldn't hold above, and moved to the next heavy resting liquidity at 322, where it couldn't hold below, and buyers stepped up above, coupled with the refreshing of the bid liquidity, which signaled an exit and was the low of the day. So this was the example I was trying to show you last time on the last example, where I said I kind of jumped the gun as far as, again, the parameters are you want to be waiting a minimum of 15 minutes below VWAP. In this, I got in here, and the reason being is if you start seeing these huge tails like this, especially on this huge volume where it can't hold VWAP, on this one, when you see the liquidity and book map, you'll see what I'm talking about. But this wasn't quite 15 minutes, but I got in just because. And I mean, it did come back again close to it, but I was in on these just because the selling tails, buying tails are very, very powerful. That means just immediate rejection, which means traders are caught offside, especially when you see 7.6 relative volume. So again, it tried to rally, on the quote-unquote positive news, which it was. But again, it doesn't matter what the news is. It matters how the market's reacting. That's how you make money. So are you going to be the clown that buys this because of the news, or are you going to be the informed trader that sells it because this should not be holding below VWAP? So you can see here, this was the first move. Again, this was this move here above, where it barely got above, and I saw this liquidity actually move above, selling, and the minute it started to sell back below, I'm in. My stop was right here. It sells off. It almost gets to this 323 liquidity. Buyers engage again. I'm still in the trade because I'm expecting, when you see this type of volume, you need to be expecting some outsized moves, because these guys have to get out if they're wrong, right? So I'm not looking for $1 or $2 on this move. I'm looking for much more. So again, if it trades above here, I'm out. And then even better sign is once it did this, came down here, I was even more confident because this liquidity refreshed. So my stop was here to begin with. Now I have this liquidity to lean on top of it. So I was basically, here, of course, I'm starting to say, why is this coming back? But you can see, the buyers are not really strong here. These tiny little bubbles are nothing what they were the first time. As a matter of fact, it didn't even get towards, get near liquidity. If you're more conservative and you want to see a longer time period below, you could have gotten short here, but you may have missed this trade because it didn't get all the way up to liquidity. Again, you don't always have to wait for a move into liquidity. You can trade around kind of near liquidity if you see something like this where the buyers are weak. And then you see the selling come in, you can get in right here. And, this was 324.60, risk it to 325.10. You're risking 50 cents, if you decide to wait to this area. Again, don't cost yourself a trade because it doesn't trade up into this liquidity again. If you see weakened buyers and the sellers come back in, just pull the trigger and get in here, especially if you saw this first. But again, I was in here. I did not add here. So comes down here, blows through this liquidity. The buyers it tries to poke its head above, can't hold above there at all. The sellers engage immediately. Now it's down here. So I saw it trade through 322. I think of gold, and I think I'm going to get another $5 out of this trade. And lo and behold, pops up, comes back. They try again, kind of like they did here. But this time, look at the difference. Here, the sellers, pushed it through. This time, the sellers try to push it through. Now the buyers come back in right here. Liquidity refreshes. The sellers try again. No dice. Buyers coming again. I got out right here where the buyers engaged. They tried again. Rallied up here, came back down here again. I thought I cost myself money, but it actually held right around this area and then just rip the rest of the day up. So again, it doesn't matter what it does the rest of the day. You made your, this was risking. I was risking when I got in here. I sold, around 324.80. I was risking up to, 325.10. So I'm risking 30 cents to make $3, right? And then I'm out. Again, you're not looking for, let this liquidity tell you when it's time to get out. Everybody wants to make 20 times their money. Just because you want something to happen doesn't mean it's going to happen. So let this liquidity, let the big money tell you what to do. And this told you right here, this liquidity was strong. Buyers were interested here. Again, this was positive news for the day, so you can expect, when you start to see the buyers engage, that could be it for the move, right? So these are short-term moves that you want to take advantage of, the clowns at the beginning of the day that get caught, and then, then eventually the buyers will win. So that's actually the last slide I have for this setup. Hopefully it was pretty self-explanatory. This is one of my favorite setups. It's very high risk reward. The risk reward is incredible, and you see this all the time. Especially stocks in the news. You always want to be playing stocks in play, stocks in the news, where the algorithms are not participating that day, and you get these clean areas where you can judge, what's going on. This is an incredible setup that happens basically every day. So in one stock or another. Any questions? Please send me an email, Scott@scott-trader.com, and hope you enjoyed it.